The AI supercycle just went next level. ASML crushed Q1 2026 with a massive beat and guidance hike, officially entering hypergrowth mode. Today, we're navigating the Q1 earnings report. We'll look at the headline results, the great geographic shift in revenue, the free cash flow situation, and the final analyst verdict on the bull versus bear case. The numbers are staggering. 8.8 billion euro in revenue, driven by solid AI demand. ASML hit the high end of their guidance with a 53% gross margin. Most importantly, they raised their full year 2026 guidance to a range of 36 to 40 billion euro. Looking at the US GAAP scorecard, it's a clean sweep of beats. Revenue was up over 13%, and basic EPS jumped 19.2% to 7.15 euro. They are also keeping a tight lid on stock-based compensation, which remained at just 31.1 million euro. ASML is actually selling fewer units but earning more revenue. They shipped 67 systems this quarter, down from 94 in the previous quarter. However, a surge in average selling price, fueled by two ultra-expensive high-NA EUV system sales, drove the absolute revenue higher.
Breaking down that 8.8 billion euro engine, EUV technology now accounts for 66% of revenue. Deep ultraviolet, or DUV, makes up 23%, while the highly profitable installed base management services contribute the remaining 11%. We are witnessing a massive geographic pivot to Asia. South Korea now represents 45% of revenue, a huge jump driven by memory customer expansion. Meanwhile, China's share dropped to 19% as export controls continue to take a heavy effect. ASML maintains a fortress balance sheet. They hold 8.4 billion euro in cash and short-term investments against only 2.7 billion in long-term debt. Their interest coverage ratio remains exceptionally high, providing a massive safety net. However, there is a red flag: negative free cash flow of 2.6 billion euro. Management attributes this to the timing of down payments and a spike in accounts receivable. Inventory is also up as they pre-build systems for a massive delivery schedule in the second half of the year. Despite the cash flow dip, ASML is aggressive with capital returns. They announced a final dividend of euro 2.70 and executed 1.1 billion euro in share buybacks. Total dividend payouts are up 17% year over year.
Projecting out to 2030, the goal is 44 to 60 billion euro in revenue, with a 60% gross margin target. ASML's monopoly on EUV technology creates a massive moat, allowing them to dictate pricing power as the global chip supply struggles to meet demand. The bull case centers on the insatiable AI tailwind and the transition to high-NA systems, which can reduce process steps by 10x. The bear case warns of China export license uncertainties and potential cyclical downturns in the mobile and PC markets. Our diagnostic shows a pass for stock-based compensation and reporting transparency, but we have a warning on net income versus cash from operations. Net income of 2.8 billion euro vastly exceeds the negative operating cash flow, which investors must watch closely. The final verdict? ASML is officially entering a hyper-growth phase for 2026. The guidance raise proves that their 2025 transition year successfully built the capacity needed to catch the AI wave. Watch Q2 and Q3 for cash flow recovery to confirm this was just a timing anomaly. What's your next move? Is that EUV monopoly strong enough for you to ignore the negative Q1 cash flow? Let us know in the comments. If you found this ASML earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for watching.